Hello and welcome to Money Matters. My name is Jim Butler, a partner with Marcum Wealth. And this afternoon, my co-host is Mike Dever of Brandywine Asset Management. Welcome, Michael.
Hey, Jim. Thank you.
Good to see you. Well, again, we have a really good lineup with a very interesting guest. I think the topic is going to be one that all of us can relate to, and I'm sure we're going to pick up some good insights. But before we bring Michelle on, let's chat briefly about what you and I touched on before, which we think is a very relevant topic. And fortunately, this time we're not predating ourselves in any way because it spans really a much broader time period. And that has to do with the all-encompassing fiscal policy and a little bit about our tax structure in the U.S. And this is something that you and I agreed upon, that we want to be as kind of middle of the road or agnostic as possible, because when I was doing a little bit of research, I found some facts that I thought were revealing. And so it has to do with basically taxes paid at the federal level in the U.S. The data comes from both the IRS and an analytical company called First Trust Advisors. They do actually a number of things. Analysis is certainly one of them. And what they discovered or put into available information is taxes paid on a percentage basis based on the amount of income that people earn. So, for example, the top 1% of income earners earn about 26% of federal income. In other words, reported income. So the top 1% represent about 26% of the total. However, they paid just under 46% of the total tax revenue. So we have a chart that highlights this fact, and it actually expands it beyond the top 1% and takes it all the way down in different increments, as we can see on the screen now. And instead of repeating all of those different brackets, I think what is interesting is if we go all the way to the left, where it shows the bottom 50% of income earners, which, we all are in the bottom 50% at one point in our lives. And it's just part of, society. However, they represent, according to 2021 data, 10% of income earned, but yet they pay just over 2% of the federal income tax. So by looking at the red graph as we move from left to right, it becomes more evident about how progressive the tax rate is as we speak today.
Right, and I think this is relevant, Jim, just with the discussions in 2025 over tax extensions of tax cuts, and people call them tax cuts, and it really gets down to what's your baseline that you're looking at, whether it's a tax cut or an increase. Anytime there's a change in the tax code, somebody benefits, somebody else gets hurt. Tax code, as we all know, is unbelievably complex, unnecessarily so from the standpoint of taxpayers, necessarily so from the standpoint of Congress and legislature just put it together and like to be able to manipulate behavior based on taxation. That's why it is complex. It's why it'll probably never not be complex, unfortunately. Even if it's rolled back at one point to a simple flat tax, it'll just complicate over the next couple decades as people keep adding to it. But what I thought was interesting about that graph, what you're pointing out there, is that you've got half the population, that's half the taxpayers, or the population is paying about 1/5 relative to what they earn, or like 1/10 relative to what they earn in taxes as the top compared to the top 1%, which pays, 10 times the relative earnings contribution to the national tax. And so it's a very progressive tax curve as it is, with the majority obviously being paid out of the top couple percent of the people, earnings wise. Whether they should pay more, who knows? I saw a guy on TV a couple years back who said they should pay everything. Anything over, you don't need anything more than $200,000. Anything over that should all go to the government. And obviously it's impractical. Nobody's going to keep earning money if they don't get to keep any of it.
Right.
So but it does kind of just put some stats out there that could help kind of frame the discussion when people are talking about taxes and tax rates.
Yeah, and again, Mike, we're not drawing judgment on this. All we're doing is sharing information that's available. Now, somebody, as you point out, may disagree and say, no, in fact, it's a very fair bracket because people that earn more should pay more. And while there's a misunderstanding when you hear the term fair share, and how, whether it's the media or politicians, abuse that, I think as a taxpayer, we owe it to ourselves to do enough homework to understand, well, what does that really mean? And where do I fall in the discussion? Because all of this information, particularly today in the age of the internet, is readily available.
That's right. Yeah, it's interesting. I mean, you could argue, any number of ways, and you could skew the facts any number of ways you want to look at it, and you could argue that, hey, so people shouldn't pay any tax until they have at least enough to live on in a reasonable amount. Maybe, and that depends on where they're living. I have a son in Kansas. It's not the same in Kansas as it is in New York City. Okay, well, that's very interesting. It's good to have the facts before people start making the arguments.
Let's move to our question, if we could. Jack Lewis in Philadelphia writes in, what are some defensive investments that I should consider as a long-term investment?
So that's actually a simple question with a very difficult, no one-size-fits-all answer. There are a lot of ways to come up with more conservative, defensive type investments to protect yourself against risk defined as maybe inflation risk. Most people look at it as just a drawdown risk from a bear market. They define risk that way. You might want to define the risk as what's your probability of earning enough in retirement to pay for the lifestyle that you want to live. So there is no one size fit all, but there are some rough defensive type moves that people make into higher dividend stocks, for example, higher yielding assets. There are a number of funds that are out there now that provide some downside protection to them. Almost all of these come with a cost, though, in capping upside performance. It's difficult to find anything that's unique enough that provides downside protection but preserves upside opportunity. So it's really something I think you need to talk. I usually try to give an answer, but in this case, I think it's somebody that has that question really needs to talk to a wealth manager or financial planner, somebody that can help guide them based on what their requirements are, how they're going to live off that money.
Sure. Yep. Good answer. Thank you. And if you have a question that you would like our panel to address, here's the way that you can send that in.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Let's welcome our guest, Michelle Hirsch of Brunswick Companies. Welcome, Michelle.
Hello.
How are you?
Happy to be here. Great. Thanks so much for inviting me.
Absolutely.
Hello, Michelle.
Hello.
So, Michelle, for the benefit of our audience and future audiences as we share this link going forward, Can you give a brief intro to your background and who is Brunswick?
Absolutely. So 30 years, I'm sorry. Yeah, wait, no. I have been doing this for over 22 years. My grandfather started the business 50 years ago in third generation. And we are a property and casualty broker. I hate the term broker because I feel like it sounds very transactional. We like to think of ourselves as a property and casualty concierge. So we work with clients on their personal as well as their businesses for their property and casualty, all of their property coverages as well as their liabilities to make sure that all the assets that they have worked so hard to create are properly protected. We work with an array of carriers that you as the consumer can't go to direct. You have to work with a broker to place. Then we service and really just put our arms around you to show you the love on all of your insurance needs throughout the year. So whether or not you have a change, you buy a new car, should I turn in this claim? Should I not? Those are all the things that at Brunswick, we step in to be your all-knowing source for all things insurance.
So what would you say is one of the primary advantages of using a broker, as you say, for your clients?
Absolutely.
Kind of doing it themselves.
Sure. So when you do it yourself, it's the luck of the draw. You are calling an 800 number. You might be talking to someone who isn't licensed, who's reading a script. You might be just, kind of out on your own. When it comes to the broker, we're there to be all things advocate for you. So not just guiding you into all the different options of what you can buy and the difference and explaining the different coverages and what they actually mean, but also in the time of need. You buy insurance for when you have a claim. So when you have that claim, having a broker have your back. Escalating it to the boss's boss's boss if you're not getting what you want. We've fired carriers in the past and moved entire books of business because we didn't like the way that they handled the claims. Really working with that adjuster to make sure that the expectations are set and the communication stays strong and that the coverage is interpreted the right way so that people aren't left being underinsured or not getting what they want to eventually make themselves whole again.
Well, Michelle, how many different brokers do you work with, and what are the differences with the brokers? Why would one person end up with one broker and somebody else with a different broker?
Great question. So you should really only work
or
with
not
one.
a broker, I'm talking to coverage.
The carriers,
coverage.
right.
The
Well,
carriers.
kind of both. You'd be shocked. There's some people that use multiple brokers to get to multiple carriers, and that's also not the right way to do it. Sometimes, like, we're licensed in all 50 states, but some brokers are limited to the states that they can place business in, as well as the carriers that they have access to. So a broker is only as strong as the number of carriers that they have. We have all of the high net worth carriers that the options are out there. So you're getting a real options of the marketplace. The carriers all have very huge differences. No two carriers are the same when it comes to their coverage. Just because you have a homeowner's policy doesn't mean that policy is exactly the same. 100 pages in the back with the small print that no one likes to read, those exclusions, those definitions, the actual coverage and how it responds is different amongst every single carrier.
Are there some, let me rephrase that. What are the common mistakes that buyers or insureds make in researching this and making a decision?
For sure. Well, I say first is doing it on their own because that's never a good idea. Second is underinsuring their home. So the stat is that 70% of Americans are underinsured on their home. And we're seeing this very sadly in California right now with the wildfires. So many people, maybe they insured the house for, what they thought market value of it or what they bought the house for, not new construction. The insurance company is on the hook, and what the value of the dollar of the dwelling amount that should be listed on your homeowner's policy is how much it would cost to clear the rubble, redo the foundation, and rebuild that same square footage from the ground up with new construction. And most people don't realize that. The other thing to note is that different carriers have a different definition of replacement costs. Most carriers know that no project is ever on budget. Even if you're the only house in the neighborhood that burned down, the cost of lumber could increase, the cost of, bringing in the marble, whatever the case may be. Who's ever had a construction project that's on budget? Looking out at California, you have entire neighborhoods just desolate, just completely obliterated. It's apocalyptic. To get contractors to even take your call, to even get a bid, I mean, these numbers are going to be, double, triple, quadruple now, just pure supply and demand. Well, the carriers know this. The good carriers know this. So on the higher end carrier policies, they have what's called guaranteed replacement cost. So it might say on your policy that your policy is your home, we're charging you for $1 million worth of coverage. But if that quote comes in and you cannot rebuild that house for less than 1.8, some carriers will write the check for the 1.8. Other carriers will say 1 million, not a dollar more. Anything over that is out of your pocket. And then there's carriers that do things in between, like 120% or 150%. So most people, I would say, that coverage line, that dwelling coverage A, is always underinsured. The other thing that we see often is low deductibles. So especially in this environment, insurance is for the catastrophic. The pictures that we're seeing, this is now what insurance is for, hoping that you have the right amount. Small claims, things that happen that you could write a check for, insurance should not be a maintenance policy. And too often we see people turning in those small claims. Frequency is actually looked at just as bad as severity. A carrier, you have a higher percentage of getting non-renewed for turning in lots of little claims than for a big bad claim. And so increasing that deductible, especially for our clients that have the cash flow, if you're not going to turn in anything under 10 grand, make your deductible 10 grand. You'll save significant dollars on the premium. And it's a nice reminder that I can't turn in that claim because I'm not going to. So
you answered my question. I was going to ask what the minimum might be for deductible. And
yeah.
Is that like $1 million house? Is it a $10,000 deductible?
The value of the house really doesn't have anything to do with it. Obviously, I can't speak for people's cash flow. So it's really more, we have personalized conversations with our clients when we're bringing them on board, and we do complimentary audits with clients. And we say, what's that number? Like, where would you feel comfortable? I would say, like, out of the box, absolutely nothing under 5,000. We're seeing more and more of our affluent clients go to 10,000 or even 25,000. The high-end carriers also have a coverage endorsement in their policy that's called a waiver of deductible. So if a property claim were to happen that was over 50,000 or 100,000, depending on the state, depending on the carrier, they actually waive your deductible completely. So for those catastrophic losses, you're most likely not paying anything. So the savings that we're seeing by increasing those deductibles and offsetting those claims is huge. And most people are sitting around with $500 deductibles, $1,000, $2,500 deductibles. We've saved so much money on that. What I always say is, what's really going to change your lifestyle? It's not going to be when you need new gutters. It's not going to be when, you have a little kitchen fire and to redo this area is $15,000. What's going to change your life is, God forbid, if you're in a car accident and you hit someone who, let's not even talk about worst case scenario. Let's just say they're a world-renowned surgeon and they can't operate. And now you have to pay their salary for X amount of years. It's the catastrophic, that injury prone, that umbrella coverage, which I know we're going to talk and chat about. I'd rather say increase your deductible, take that chunk of money that you're going to save on your homeowner's policy, and let's go up your umbrella, because that's the stuff that we really want to protect that could be life-changing.
So Michelle, you mentioned before about what's going on in California, just as a recent example with the wildfires. And then of course, fairly recently, we have flooding taking place down in some of the southern states, and then we have hurricanes and tornadoes that come through. I mean, these are all things that you probably have seen more times than you care to. How do people cover themselves when they're exposed like that?
Yeah, it's getting even more challenging. These natural disasters, the statistic for 2023, 2024 hasn't come out yet, but the number of single billion dollar losses has increased significantly. I mean, to the point of over 20% year after year. So these convection storms, which is just a very technical term for saying really, really bad weather, it's it used to be the hurricanes in Florida, the wildfires in California, and everybody in between was kind of just there. Not so much anymore. These deep freezes, the tornadoes. If we looked at the map of all of the single billion dollar events, it is very evenly distributed across the country. So how they're going to get the coverage is constantly evolving. There is a separate market. First, I think the state funds are going to be writing a lot more policies, which no one likes to have government insurance, but I think that's going to be probably par for course. Some of the extra large, high valued homes, newer homes that have all the risk protection devices may still fit in the standard high net worth market, depending on the rest of their portfolio. If they have homes not in catastrophic zones, as well as perhaps the brand new house that's, half a mile from the beach, maybe. So every carrier kind of has their underwriting guidelines for those risky areas. The other thing I think we're going to see a huge increase in is what's called the non-admitted market. So all of the carriers have to file their rates and file their policies and their regulations with the states, and they are called admitted. The non-admitted market, so the specialty carriers, most I would say known as Lloyd's of London. So like those types of carriers and those policies don't have to file with the state. They have more creativity. They have more leverage to kind of do whatever they want. I happen to believe that we're going to see a huge shift, that the non-admitted specialty market is going to kind of be the norm now, whereas you kind of only use that as your last resort prior to all of these losses. But I mean, I'm waiting to see what happens. I think the whole industry is waiting to see what happens. I think the carriers are waiting to see, hopefully, when these fires stop, like how and what. There's just no answer. Same with the hurricanes. It's just they're monsters.
So what's that doing then? Is that thinning out the carriers that cover and
No,
increasing premiums? What?
They're getting ahead of the game. So like my high-end carriers, the Chubb, the Pure, the AIG, the Cincinnatis of the world, they're actually opening and growing significantly their non-admitted market division. So they're saying, look, you're still going to get an adjuster, a high-end adjuster that works for us, but the paper and the definitions and the policies and the pricing is completely different than our admitted side. And so, yes, the premiums are going to be outrageous, and people just have to kind of budget for it and brace for it. We're seeing a lot of people, especially very wealthy people who don't have banks or mortgages involved, lean to a more self-insured type of kind of program, high deductibles. We have clients down south who are taking off the hurricane coverage and saving literally tens of thousands of dollars by saying, look, my deductible was so high anyways. I've been through all these storms. I kind of know what to expect as far as damage to my house. I'm going to save 50 grand a year because that's how much it was costing to have the hurricane coverage. I'll make a little storm fund, and
That was,
I'll be ready.
yeah, that was going to be one of my questions. Is how many years does it take to pay back a self-insured structure, right? If you're sitting there saving $50,000 a year, I mean, yeah, sure, you might have a really valuable property, but you might not need that many years. And the probability,
really,
obviously, is that you pay off as long as you have the money when you need it. You didn't just go on vacations and spend it
Exactly.
instead. Yeah.
Yeah, no, it's a real challenge. But if a bank is involved, or if there's any loans on it, obviously they're not going to let you do that. So it is definitely a unique situation. But we're seeing a lot more clients do it.
Hey, Michelle, I want to cover something as we wind down our time together. So I'm going to give you a question that you could spend probably 30 minutes talking about, but we don't have 30 minutes. And it has to do with some kind of policy review or update that people could go through, whether it be with Brunswick or their broker that they work with. How often should they do that? And what are the benefits of doing that?
Sure. I would say at least at the minimum every 3 to 5 years. Premiums are increasing like crazy. We're seeing the average increase right now in the high 20%. So if you haven't shopped your coverage in a while, now's the time to do it, especially with higher end carriers. It's not just one carrier in the space anymore. So I joke that, you can go to a Ritz-Carlton or a Four Seasons, you're going to go wherever the rate's the lowest, right? So having that, we do audits complimentary. So all we need is copies of the current policies, and we do a side-by-side comparison of coverages as well as pricing, so clients can understand where they are within the market. And then our real thing is we educate. We want you to understand what you have. And if you take what we've given you and go to your guy or your gal and make those changes, that's fine. We just really want to, as a complimentary service out there, no one's doing this. No one's really understanding what they have. And until you go through this kind of process, you just don't know.
You're saying high net worth. We've used that term a few times.
Yes.
What is like a typical client or property or insured value?
That's a great question. So it actually has nothing to do with your actual net worth. Most of the high net worth carriers look to your home, the home size. So if the replacement cost is at $750 or more, you would qualify. And it doesn't have to be a home. If you have a condo, you have nice art, luxury vehicles, need that higher umbrella, higher than $5 million. So I would say most people with homes over 3,000 square feet are going to qualify for high net worth.
I would say with the median home price over $400,000, it's not hard to have a replacement value of a home.
Well, remember,
$750.
it is not market value; it's replacement cost value.
That's what I'm saying.
So
Yeah, won't have hard.
No.
Yeah, won't have a hard time having replacement value at $750.
You got it.
So thank you, Michelle, and really very insightful, and
Absolutely.
And hopefully our viewers have picked up again at least one or two valuable pieces of information. Thanks, Mike, for being a part of the show as well. Our next guest is Jason Lazarus with Synergy Settlement Services. It's a company that he works with in the legal field, and I'm sure you're going to learn something from him as well. So in the meantime, thanks for listening, and have a great first quarter.